Big changes are coming if you're self-employed or a landlord in the UK, and they're not exactly welcome. The way you report your income to HMRC is about to change completely, and it's got a lot of you panicking, in some cases for good reason. Now, most people are stressing about the quarterly updates, but there's actually something else buried in the rules that could send you up the financial and metaphorical creek without a paddle. And if you don't prep for it, you'll feel it where it hurts most, in your wallet. So I'm going to explain the changes clearly, make sure you understand how they might affect you, and tell you exactly what you need to do about it. Before we get into that, there's a whole host of rumours going round about making tax digital that I need to dispel so that you can properly understand how MTD, making tax digital, will affect you. It's not, ooh, now you can send your tax return online. We've actually been doing that since broadband stopped making that lovely dial-up noise. Remember that? Anyway, you'll now have to send quarterly summaries of your income and expenses through compatible software, and I'll talk about some of these later for you. No more spreadsheets, no more scribbles on the back of receipts, no more, I'll just do it in January, because January will now come 4 times a year. But here's the kicker, those quarterly updates, they don't calculate your tax bill, they don't replace your tax return, and HMRC won't be giving you a nice little total at the bottom like it's Amazon checkout. You still have to figure it all out, or get someone who speaks accountant to do it for you. So yes, it's more admin, all wrapped up as a lovely digitised government issued bow. Now, with these quarterly returns, another wide misconception is that you'll be paying quarterly as well, but that's not actually the case. You'll still be required to pay at the end of the tax year, as the change only impacts reporting, not payment. And since it's only quarterly reporting and not payments, it also means HMRC won't necessarily uncover more tax through MTD, although it's still likely. The concern's completely valid, but the reason HMRC says they put MTD in place for income tax is more to do with the enforcing the accuracy of reporting, making it easier for them to catch out those who deliberately avoid paying what's due. Whether you agree with the system or not, currently we'll try not to get too far into politics here, as we're here to advise, not create an HMRC or Crook's echo chamber. Provided you earn the same, you'll likely be paying the same amount of tax as any other year. And the most important rumour I can debunk, however, is that MTD is optional. Newsflash, it's not. At some point, every self-employed worker and landlord will be required to file quarterly reports, no matter your business size. You don't get to opt out just because you spilt coffee on your laptop or your dog ate your iPad. So now we've covered the myths and misconceptions of MTD, let's get precise with what's actually changing and exactly when. So here are the rollout dates, and they depend on your income. If you're self-employed or a landlord and earning over $50,000 a year, MTD for ITSA, that's making tax digital for income tax self-assessment, that initialism is going to get very tiresome very quickly, but crikey, not as much so as having to say it in full. It starts 6th of April 2026. If you're over 30,000, your turn is April 2027. And if you're earning over 20,000 but under 30,000, you're not off the hook. You're just on the slow train. Your start date is April 2028. Under 20,000, you are off the hook for now. But don't get too comfortable. HMRC says they'll review the approach, which we all know is government speak for we haven't decided how to ruin your day yet. And if you're in there, it's not happening to me for ages yet, camp. Don't get complacent. You're going to want to be as prepared as you can be. It feels miles away until you panic buying software licenses at the last minute. Before we dig into the details of the changes and make sure that you're prepared to handle them, here's that sneaky extra HMRC didn't put on the billboard. Tax year basis reform. Translation: if your accounting year doesn't run from the 6th of April to the 5th of April, you have to change it, because going forward, everyone needs to line up with the tax year like good little digital soldiers. And if your current year end is, say, July or December, you could end up with overlapping profits, which means, being taxed on the same money twice, temporarily, sort of. It's kind of like lending your mate 50 quid and then paying interest to borrow it back. It doesn't feel quite right, does it? You do eventually get the relief back, but it can take years. So brace yourself for a little cash flow gymnastics. Plus, it should have already been put into effect in your account. So if you haven't changed your year end and it isn't now the 5th of April, you need to speak to someone ASAP. And the link to get in touch with us is at the bottom, or make the change yourself. If you found this helpful so far, hit subscribe. We post weekly guides that make UK taxes a lot less painful. And if it ever stops being useful, no stress, you can unsubscribe faster than you can say, what on earth is a basis period? Okie dokie, as promised, now we dig into the details of those changes. So, firstly, total income. What does it actually mean? Income means the total gross income or turnover, not profit. And if you have more than one source, such as a different trade or property businesses, then it's the total. For example, if you've got 15,000 rental income and 36,000 from your sole trader income, then you fall into the 50,000 bracket, which starts next April. Then secondly, what if your income has dipped and changed? Well, to decide which bracket you fall into, HMRC will look at the tax return that's got the filing deadline just before the start of that tax year the income will trigger entry to. For example, for 26-27, the first tax year that MTD will be applied, HMRC will look at the figures for the return in your 24-25 year, because the filing deadline for that is the 31st of January 2026. So they're checking, did your income go over 50,000 in this period? So the period from last year basically up to the 5th of April this year. So you will know now if you're going to fall into it. If it did, bang, you're in from the 6th of April. For the 27-28 MTD year, HMRC are going to look at the figures for the return for this current year, 6th of April just gone to the 5th of April 2026, because the filing deadline for that is the 31st of January 2027. Will your income go over 30,000 in that period? If so, you're also in. So that's about as clear as builder's tea in a blackout. But what about new businesses? Well, if you start trading partway through a year, the turnover should be grossed up, so divide it by how many months you actually traded, then times it by 12 to give an estimate. And finally, what if you drop below the threshold for reporting? Well, you can only become exempt if you fall under for 3 years in a row. As if you drop below once, HMRC think it's a fluke. Twice, they're a little bit suspicious. 3 times, okay, now they finally believe you're actually skint. Or just very, very clever with your accounting. The kind of clever I explain in my 10 ways to pay less business tax video. And I'll link that in the description if you want to check that out next. Well, now we've covered the details of the changes. And just before I explain how you just might be able to avoid it altogether, I'll explain what you actually need to do if Making Tax Digital is coming up on you fast. Firstly, talk to your accountant, or if you don't have one, maybe start by making approaches. Bring flowers. Say things like, I've kept all my receipts. They love that. Test the software. Most offer free trials, and better to find out now if you hate it rather than 11 o'clock on deadline day. And as promised, here are some examples of compatible software you can use for Making Tax Digital. Firstly, free agent. This one's usually best for freelancers, landlords and small business owners, and it's free with NatWest if you bank with them. Then there's Zero, a bit more tailored to small, medium businesses, but it has a modern interface and great integrations with other apps. QuickBooks, probably the easiest to use. It can help give real-time insights and has a mobile app that has just as much functionality as a desktop version. Sage. Now, this one's for slightly bigger businesses that need advanced reporting and scalability. If you're looking to grow your business exponentially and need something slightly more complex, this one might be for you. But get your records in order. And no, a box labelled receipts, lol, doesn't count. Even if you're under the threshold for now, start preparing, because nothing in tax ever stays simple for long, despite HMRC setting up an office called, wait for it, the Office of Tax Simplification. And no, that wasn't a joke, though some of their ideas certainly are. We've linked a free checklist below to help you prep for making tax digital. Plain English, no nonsense, and no pressure. Now, as I mentioned earlier, there are a few ways to avoid ITSA MTD. Firstly, automatic exemptions. If you don't have an NI number on the 31st of January, then you're exempt for the following tax year. Now, this might apply to anyone that's recently moved to the UK from abroad and is in the process of applying for an NI number, or if you're a UK resident under the age of 16. Trustees, personal representatives and foster carers are also exempt. And you might be thinking, that's not fair. But there is valid reasoning behind this exemption. Trustees and PRs are usually responsible for administering or managing income, trusts or capital gains on behalf of other people. So this means they're not actually managing their own personal income. Trustees specifically have distinct legal and tax obligations and typically file in through an entirely different return called an SA 900 or a trust and estate tax return. PRs, on the other hand, are recognised by HMRC to have a temporary responsibility, as it's usually part of a legal duty they've got to carry out. It's not a regular taxable activity. And as for foster carers, well, they benefit from special tax schemes called Qualified Care Relief, which can reduce taxable income to zero. On top of this, most foster carers usually earn below £1,000 anyway, which is the threshold for submitting a personal tax return. HMRC recognises that foster carers' tax fares are atypical, and including them under the MTD ITSA would result really in unnecessary quarterly filings with little to no taxable income to report. So they pretty much are leaving them alone. Then there's exemptions that you need to apply for. Digital exclusion is one of those. Now, this includes people who struggle to use computers due to their age, a disability, or their location. And those if you're in the middle of an insolvency procedure, for example. Also, if your business is run entirely by practicing members of a religious society whose beliefs are incompatible with using electronic communications or keeping electronic records, such as the Most Holy Order of the Teapot and Jam, then you won't be expected to file your tax return online, although HMRC does ask that you don't submit it in crayon on the back of a rich tea biscuit. Then also an important one, which is not publicised, but very simple for anyone self-employed wanting to avoid MTD altogether. Incorporation. Limited companies don't fall under the MTD quarterly filing regime, as it's much more complicated, and currently HMRC have got no mandated timeline for bringing it about. And on top of that, limited companies also don't have payments on account. That's the HMRC system of paying half your tax in advance every year that sole traders have to abide by. And then on top of that, any sole trader business with income of 50,000 and over, and particularly if you've got net profits of about 35,000 or more, then incorporating to a limited can be really beneficial, just even from a tax point of view. And then for landlords, Section 24 doesn't apply to limited companies, as they can deduct 100% of mortgage and finance costs from rental income as a business expense. That's one of the key reasons most new property purchasers looking to build a portfolio or property business are going down the limited route. But be aware, it can be more complex and costly to switch existing properties across because you might have CGT and stamp duty that will apply. Incorporation is one of the key ways to legally nope out of MTD for ITSA, like a furry genius dodging an exploding kitten. If you want to know more about registering a limited company, you should check out our video, How to Start and Register a Limited Company in the UK. Now let's talk about what happens when you ignore these changes, because I get it, you might be tempted to wing it or deal with it when HMRC comes knocking. But let me tell you, burying your head in the sand could cost you far more than just a headache and a freezing cold backside. Making tax digital for income tax comes with its own penalty system, and it's not just a look of mild disappointment. Making tax digital for ITSA introduces a points-based penalty system for late submissions, and it's a lot like the MTD for VAT. We've covered that before in the VAT videos. Every time you miss a submission, you earn 1 penalty point, and that's not a good thing. Once you hit the threshold, which is 4 points for quarterly reporters, HMRC charges a £200 fine. And from that point on, every further missed filing triggers another £200, even if your points total doesn't increase. It's like getting stuck in a penalty hamster wheel. Once you're in, it's very hard to get out and almost never ending. Now, before you start worrying, these points don't last forever, but it's not a quick, clean slate either. If you manage to file everything on time for 12 months, the points reset. But remember, that's 12 months of squeaky clean submissions across all obligations. Miss just one, the clock resets again. It's not just late filing that stings also. MTD doesn't change the payment deadlines, but if you're late paying your tax bill, you'll be hit with interest from day one. And currently that's 7.75% per annum as of May 2025, and it accrues daily. Missed payment by 15 days, and HMRC will charge a 2% penalty on the outstanding amount. At 30 days, it's another 2%. And if it drags on, more penalties follow. And suddenly, that £3,000 tax bill is looking more like £3,500 before you know it. So this means that if you're not keeping accurate digital records, or you forget one of those new quarterly reports, it's not just a form you've missed, it could be hundreds in fines, plus your rising interest on unpaid tax. These aren't rogue or discretionary fines either, they're hard-coded into the new penalty framework. And once you're in that penalty zone, HMRC won't be sympathetic because you forgot your login or the internet was down. They expect you to be using compatible software and to keep digital records. That's the baseline. So if you haven't already done so, start trialing software now. Talk to your accountant, get comfortable with the process before mandatory date rolls around, because prevention costs a lot less than penalties, trust me. If you found this useful, chances are someone else you know needs to hear it too. Share this video with a friend, colleague, or anyone who's ever shouted, "I'll sort the books out tomorrow," across the room. Let's make tax and finance a little less painful and maybe even a little more fun.